Hey everyone, welcome back to the channel. Today we're diving into an important topic, the central bank. What it does, why it matters, and why it sometimes struggles to achieve its goals, especially in developing countries. Let's get started. The central bank is a government-owned institution that manages a country's money, credit, and banking system. It plays a major role in keeping the economy stable and strong. Here are its key functions. 1. It issues the nation's currency, ensuring every note and coin is legally backed. 2. It controls monetary policy, adjusting interest rates and money supply to manage inflation and support growth. 3. It regulates commercial banks, keeping the banking system secure and trustworthy. 4. It serves as the government's banker, managing public debt and foreign reserves. But here's the big question. If central banks are so powerful, why do many of them, especially in developing countries, fail to achieve their objectives? There are a few key reasons. Political interference. Sometimes governments pressure central banks to finance budget deficits or keep interest rates low, even when it's bad for the economy. Weak institutional independence. Many central banks in developing nations don't have full autonomy to make decisions based purely on economic data. External shocks. Things like oil price hikes, global recessions, or exchange rate pressures can overwhelm local economies. Limited financial infrastructure. Poor banking systems, low savings rates, and weak regulation make it harder for central banks to implement effective policies. Data and policy challenges. Incomplete economic data or slow responses to crises often mean policies come too late or aren't strong enough. So while central banks are designed to keep the economy stable, their success often depends on independence, good governance, and strong economic structures. Let's take a closer look at a real example, Kenya. You might have noticed that the exchange rate of the Kenyan shilling has remained fairly constant recently. Is that normal? Well, in most countries, exchange rates usually fluctuate depending on market forces like exports, imports, and global demand for their currency. So when an exchange rate stays steady for a long time, it can mean the central bank is taking specific actions to stabilize it. The Central Bank of Kenya, CBK, may be maintaining the stability of the shilling through a few possible measures. Foreign exchange interventions. The CBK can buy or sell US dollars in the market to influence the supply and demand for Kenyan shillings, keeping its value within a desired range. Interest rate adjustments. By raising or lowering interest rates, the CBK can attract or discourage foreign